The tax code is built for business owners, but most business owners don't do any real tax planning. Why? They don't hire people to help them with it. The information is really hard to understand and make decisions on. The internet is full of information that contradicts itself. So today I'm going to walk you through some moves that as a business owner you can make to lower your tax bill. The first one is getting your entity structure correct. So when you ask most people, they're going to tell you, hey, I'm an LLC. And at the end of the day, the LLC is basically your legal entity structure, but it's not your tax structure. The way that you're going to be taxed is a partnership, sole prop, C Corp, S Corp. And picking the right one can be the difference in a lot of tax savings. Let's look at a couple of them. So C Corps. C Corps are really great for tech companies that take on capital, that are trying to have a bunch of investors and grow and sell one day. And they'll get qualified small business stock, which basically allows you to exclude $10 million of capital gains upon a sale. Imagine not being in that entity structure and missing out on that tax savings. The next one is S Corps. So S Corps can be really great for saving on self-employment taxes. Let's say, you have $150,000 of profit. If you're just a partnership, you're going to be taxed on self-employment taxes, federal and state, all the way to the 150. If you're an S Corp, you could potentially pay yourself a $90,000 salary. That's subject to federal and state taxes, and then pay the other $60,000 through profit, which avoids self-employment taxes, which is 15.3%. So you'd save over $7,500 on taxes. But that's only part of the story. You still have to think about how much less you can put in a retirement account. You still have to talk about the qualified business income deduction. So the next one is really optimizing the qualified business income deduction. So I just alluded to it. So as an S Corp, until your salary hits until your salary or profit hits a certain threshold, your AGI, what ends up happening is you get a deduction of 20% of business profits. So let's say you have business profits of $300,000 and you have 20% of that is a qualified business income deduction. So you get a $60,000 deduction. But once you get above a certain AGI, it becomes the lesser of 20% of business profits or 50% of W-2 wages if you're not an SSTB. An SSTB is like a financial advisor, a lawyer, somebody who the business is really just kind of from their name, image, and likeness. If that's you, then you completely phase out and get no deduction. But if you are somebody who's going to get this deduction, and let's say that you're just a partnership, right? Your AGI is too high, you pay no salaries, then at the end of the day, your qualified business income deduction is going to be zero because it's the lesser of 20% of business profits or 50% of W-2 wages. But if you're an S Corp and you move up to there, and let's say you have $700,000 of profit, and let's say you pay yourself $200,000 in salary, $500,000 in profits, then at the end of the day, you get a $100,000 deduction for a W-2 wages, and then 20% of 500 is 100, so you've optimized it. Now you get a $100,000 deduction. So maximizing this and planning to get them to be as equal as you can is really important and can be the difference of $10,000 to $100,000 in tax savings by getting this right. The next one is walking through business retirement accounts. So business retirement accounts are something business owners ignore all the time. Why? Because they don't really know which one to use and they're just so focused on investing back in the business. But at the end of the day, when you start to make a lot of money, your tax bill gets really high, deferring taxes to the future can be really advantageous. So that last example I had of somebody making, they have $700,000, $200,000 salary, $500,000 of profits. Let's say they're the only employee and they can set up a solo 401k. They can do $22,500 into the solo for 2023 or $23,000 for 2024, and then 25% of the wages you paid yourself. So based on 200,000, that would be 50,000. That's more than the annual 69,000 this year, but you'd be able to defer $69,000, which is all a deduction, saves you federal and state taxes on that. And when you're in the 37% bracket plus state, that's a lot of tax savings. So you want to nail down solo 401k, SEP IRA, etc. I have other videos walking through that, but in most situations, solo 401ks allow you to defer more at a lower amount of salary than what a SEP IRA would be. But if you have a bunch of employees, then it might make sense to set up a safe harbor 401k that you can defer into. So at the end of the day, those are three of the most advantageous tax planning moves for business to start with. There are way more, but everything starts with entity structure, how you pay yourself, the qualified business income deduction, and business retirement accounts. From there, we can talk about accelerating and deferring income. We can talk about charitable giving. We can talk about utilizing trust. There's a lot of other things to think through, but it all starts with those three, and that's what you want to nail down from the beginning. Thank you for watching. If you enjoyed this video, please leave a like and go subscribe to my channel for more personal finance content. And as always, please leave your thoughts in the comments below, and I promise to get back to every single one of them. We'll see you back next week.